Welcome back to The Deep Dive, the show where we cut through the noise, unpack complex subjects, and get straight to the insights you need to be truly well-informed. Today, we're plunging into a topic that has sparked more spirited debate, confusion, and frankly, outright skepticism than almost any other in recent financial history. Bitcoin. It's an asset that's gone from this obscure online curiosity to a trillion-dollar behemoth. Yet for many, the fundamental question persists. Why does Bitcoin have any value? Especially when it doesn't generate cash flow like a traditional company or pay a dividend. It's a critique we hear all the time, often leading to, well, a dismissive shrug from even savvy investors.
Yeah, and if you want to understand the core of that skepticism, you don't have to look much further than one of the most famous investors of all time, Warren Buffett. He famously, or perhaps infamously, called Bitcoin rat poison square.
Oh, no.
That quote for so long really encapsulated the challenge for those of us who have followed this space. How do you reconcile that kind of deep-seated doubt from a titan of traditional finance with Bitcoin's undeniable and continued rise, not just in price, but in adoption? It's a cognitive dissonance for many people.
That's precisely the tension we're diving into today. I've always found it challenging personally to reconcile Bitcoin's meteoric rise with those traditional investment models. So our mission for this deep dive is clear. We're going to peel back the layers and unpack exactly how Bitcoin generates its value despite not fitting into those conventional financial frameworks. We'll analyze its role as a store of wealth, comparing it head-to-head with gold, even traditional fiat currencies. And then we'll peer into the powerful, almost tidal forces that are currently driving its price and making it such a compelling asset. Finally, we'll trace its remarkable evolution from what many initially dismissed as, a risky niche novelty into a surprisingly mainstream, institutionally adopted asset. We're going to break all of this down into layman's terms, with clear, relatable examples and connections to everyday concepts, giving you that shortcut to truly understanding this complex, fascinating topic without getting bogged down in jargon or, frankly, outdated assumptions. So let's unpack this. All right, let's go directly to that central critique, the one that makes so many traditional investors scratch their heads.
Bitcoin doesn't have traditional cash flow. When you think about valuing a company, right, you look at its revenue streams, its profits, its potential for dividends, its discounted future earnings. Bitcoin has none of that. So for a mind steeped in traditional finance, how can it possibly have value? It truly is a conundrum for many, almost defying logic at first glance.
It absolutely is, and it's a very common point of confusion. It trips up a lot of seasoned professionals. But the core issue here, as you rightly point out, is that this critique fundamentally misjudges what Bitcoin is and what it sets out to do. It's not a business in the traditional sense, and it's not meant to be one. Its value doesn't derive from quarterly earnings reports or future projected profits or the expectation of a dividend payout from some central entity. Instead, its value comes from the service it provides. It's a utility, really, a foundational layer rather than a corporation seeking profits.
Ah, the service. That's a crucial distinction and a powerful reframe. So you're saying Bitcoin isn't a company you invest in, but more like a utility or a tool you use. That shifts the entire paradigm. Tell us more about this service. What exactly is it providing?
Precisely. Think of Bitcoin as providing a specific, increasingly in-demand service. The ability to store wealth in a digital format without relying on any traditional third parties. No banks, no governments, no central intermediaries whatsoever. It offers a level of financial independence, self-sovereignty, and, importantly, censorship resistance that is fundamentally unique in the digital age. It's a decentralized network that allows for the secure and immutable transfer and storage of value, something increasingly difficult to find or rely on in many parts of the world today.
That makes a lot of sense conceptually. But can you give us an analogy, something to help our listeners really grasp that concept? Because we're used to paying for services like a monthly subscription, right? But not usually by directly acquiring the underlying asset itself as the sole means of access.
Absolutely. Let's use an analogy to clarify this. Think of Bitcoin as providing a service, much like Microsoft provides services through products like Microsoft Word or Excel. When more and more people want to use Microsoft services, maybe they need to write a document for work, or manage complex data in a spreadsheet, or collaborate remotely. They buy the software, or they pay for a subscription to Office 365. And as the demand for those specific services grows, as more and more people find utility in Word or Excel, the overall value of Microsoft stock tends to go up. It's a direct reflection of the utility and demand for their services.
Okay, so the parallel is that when more people want the specific service, Bitcoin provides this ability to store and transfer wealth digitally independently without censorship. The demand for that service drives up the value of Bitcoin itself, even though there's no Bitcoin Inc. to subscribe to. The only way to access that permissionless, borderless, secure service is by acquiring the Bitcoin itself. That's a fundamental difference from a traditional company, but the underlying principle of value creation through providing an in-demand service is strikingly similar.
Exactly. You nailed it. You can't pay a monthly subscription fee to Bitcoin to get its service. The only way to gain access to this unique capability of storing wealth digitally and independently from traditional institutions is by owning Bitcoin. And that's why its value is driven by the demand for that service. This isn't just theoretical either. It's a profound reality for a rapidly growing segment of the global population. Over 100 million people globally are already actively using Bitcoin as a digital alternative to fiat currency and even to gold. They use it because they fundamentally value the unique set of services it provides.
Wow, 100 million people. It's a staggering number. So what are the core essential attributes that make this service so profoundly valuable to so many? What makes it stand out?
The value, at its core, boils down to a few essential intertwined attributes that, when combined, create something incredibly powerful. First, it's scarce, and crucially, its scarcity is verifiable and immutable. There's a mathematically fixed supply of 21 million bitcoins. This supply issuance schedule is pre-programmed and cannot be altered by any central entity, government, or corporation. That's key. This is completely unlike gold, where you can always mine more, or fiat currencies, which, well, can be printed endlessly at the whim of central banks. This programmed scarcity, reinforced by something called the halving, where the rate of new Bitcoin creation is cut in half approximately every 4 years, makes it a truly unique digital asset.
Okay, scarcity, that's huge. What else?
The second, it's incredibly portable. And not just portable in the traditional sense, but uncensorably portable. You can move, say, $1 billion across the globe in minutes, securely and at minimal cost. Try doing that with physical assets or even large sums within traditional banking systems, which are subject to geographic restrictions, time delays, potential seizure.
Right, impossible, basically.
Exactly. Think about moving that kind of value across hostile borders or to help family in a crisis zone. Third, it's remarkably secure. It's protected by cutting-edge cryptography and a massive decentralized network of computers, miners, validating transactions through proof of work. This makes it incredibly difficult to counterfeit, double spend, or seize. Unlike a bank account, there's no central server to hack, no single point of failure. It offers a level of digital security and self-custody that empowers individuals.
Okay, so scarcity, portability, security.
And fourth, by design, it's outside the reach of inflation caused by government money printing. In an era where central banks are increasingly resorting to quantitative easing and expanding money supplies, diluting the purchasing power of traditional currencies, Bitcoin offers a hard-capped, deflationary asset. It functions much more like a robust foundational monetary network. It offers financial access, security, and independence qualities that are becoming increasingly hard to find or reliably access within traditional financial systems. It's truly a new kind of financial infrastructure.
That expanded view of its characteristics really drives home the unique value proposition. Now, when we talk about storing wealth, the immediate comparison for many people is, of course, gold. For centuries, gold has been seen as the ultimate stable store of value, especially during times of economic uncertainty. But you're suggesting that this idea of gold as perfectly stable might be a bit of a myth.
It absolutely is a bit of a mythical idea, and it's one that's worth challenging. While it's true, gold has protected value over very, very long periods. We're talking 5,000 years of history here, which is remarkable.
Right.
The widespread perception of its unwavering, non-volatile stability in the short to medium term is often, well, misguided. If you look at the raw data, gold has experienced some pretty brutal downturns, far from the calm, steady ascent many imagine. For instance, after the Reagan era in the early 1980s, gold saw a staggering 65% plus drawdown in value from its peak.
65%. Wow.
Yeah. And more recently, post-2010, it experienced another substantial drop of over 45%. So, yes, while gold certainly has its historical place and its merits, the idea that it's this perfectly calm, non-volatile asset that always holds steady is simply not supported by recent historical performance. It can be highly volatile.
That's a critical perspective that often gets glossed over. We tend to remember the narrative, right? Not the messy details. So if gold isn't always the perfectly stable asset we imagine, How does Bitcoin, with its reputation for wild swings, actually compare, especially in more recent turbulent times?
This is where it gets really interesting and quite compelling. Let's look at a concrete, very recent example. The period since the COVID-19 pandemic began. During that time frame, largely due to unprecedented monetary expansion and inflationary pressures globally, the US dollar has lost about 29% of its purchasing power.
Almost a third of its value gone.
Right. Its value has been significantly eroded. Now compare that to Bitcoin. In the exact same time frame, Bitcoin has increased, oh, wait for it, 30-fold.
3 times.
30 times. Think about the profound difference. The dollar, the global reserve currency, lost almost a third of its value, while Bitcoin multiplied its value by 30. That's not just a dramatic difference, it's a seismic shift in relative performance as a store of value over that period.
30x. That's astonishing. It really puts things into perspective when we're talking about preserving and growing wealth in this, well, rapidly changing economic landscape.
Indeed. This dramatic difference really reinforces the argument that Bitcoin can be an incredibly effective and arguably, in certain periods, a superior way of storing value compared to both traditional fiat currencies and even gold. In fact, our insights from Bitwise, a leading asset manager in the space, suggest that Bitcoin is, in many ways, better than gold when viewed through this lens of long-term value preservation and growth potential in the digital age. It's certainly a compelling counter-narrative to the long-held idea that gold is the only true safe haven. The landscape is definitely shifting.
Okay, that kind of explosive growth leads many to wonder if there's any traditional way to even make sense of its value. If cash flow isn't the metric, and if traditional models struggle. How is Bitcoin typically valued by analysts? What models are people trying to apply, and why are so many of them, well, missing the mark?
That's a great question, and it highlights a common pitfall in the crypto analysis space. Having worked in crypto for years and even written the CFA's Guide to Crypto.
Oh, wow.
Yeah, I can tell you that crypto analysts have historically been, to put it mildly, absolutely terrible at valuing Bitcoin using traditional methods. They've tried to force it into various models, but these attempts are often overly simplistic based on shaky assumptions or just plain flawed in their application to such a novel asset class.
Can you give us some examples, maybe some of the models our listeners might have heard thrown around?
Sure. Well, you might have heard of the stock-to-flow model. This theory suggests the value of Bitcoin is directly related to how much new Bitcoin is being produced relative to the existing supply. It implies that because the new supply issuance keeps decreasing because of those halvings, the price will just go up forever in this predictable exponential curve.
Which sounds great, but maybe too good to be true.
Exactly. The critique here is that while scarcity is real, relying on a purely statistical correlation from past cycles without considering changing market dynamics or other demand factors, well, it can lead to an unsustainable predictive premise. History shows simple correlations don't always imply causation, right? Then there's Metcalfe's law, which basically says the value of a network is proportional to the square of the number of users. Applying this directly to Bitcoin also suggests an endless upward trajectory. The flaw? Well, network effects are powerful, sure, but they aren't infinitely exponential, and it's not just about any user. It's about active, meaningful users.
Okay, so stock to flow, Metcalfe's law.
Mm-hmm.
What else?
And perhaps the most visually misleading is what's called the rainbow chart. It color codes different price ranges, suggesting Bitcoin bounces predictably between, like, purple for buy and red for sell zones. It looks pretty, it captures some past cycles, but it's purely descriptive, a post hoc rationalization. It's a terrible way to run any kind of serious, forward-looking financial analysis. These models tend to be overly optimistic or just ignore fundamental economic shifts.
So if these complex, often flawed models are not the answer, what is the simple truth? What really drives Bitcoin's price with such consistent force?
The simple truth is just that. Bitcoin's price is a direct, powerful result of limited, perfectly predictable supply and incessantly growing demand. It's basic economics 101, but with unique, almost unassailable characteristics that make it unlike almost any other asset. It creates this fundamental imbalance that just drives its value.
Okay, limited supply and growing demand. That sounds intuitive, but can you give us a vivid picture, a metaphor maybe, to show how that plays out for Bitcoin specifically? Because it feels like an extreme case.
Absolutely. Let's use a metaphor to really illustrate this core dynamic. Think of Bitcoin's fixed, unalterable supply as being like a limited number of seats on a highly sought-after, pre-booked flight. Imagine there are only a certain number of tickets available for this flight, and that number is strictly capped, known in advance. For Bitcoin, only around 164,000 new coins will be created through mining this year. And that number cannot be changed, cannot be inflated, cannot be printed away by any central authority. It's part of the code, a fixed, immutable cap on new supply, which gets even tighter with those halvings.
Okay, limited seats on the flight. Got it.
Now, as more and more people want to get on that flight, as more individuals, more institutions, even governments decide they desperately need a seat for their wealth, their treasury, their strategic reserves, the demand for the existing limited seats skyrockets. With such a fixed, immutable supply and rapidly increasing desire to acquire the asset, the price is simply forced upwards. It's a classic economic squeeze, supply and demand, but playing out on a global scale with an asset whose supply schedule is mathematically transparent and totally inflexible. The fundamental principle is that simple, but the scale and nature of the demand coming in now are truly unprecedented.
That's a perfect illustration. It highlights the basic, almost unavoidable economic forces at play. And what you just said, unprecedented demand, seems to be the key here. It's not just theoretical demand. It's a real tsunami of new, significant buyers. And you mentioned there's a structural mismatch between this surging demand and Bitcoin's fixed supply. Where exactly is this new demand coming from, and why is it so powerful right now?
You're absolutely right. It's a profound structural mismatch that's impacting the market in a way we've rarely seen. And there are three primary, incredibly powerful and distinct sources of escalating demand right now. Together, they're creating this relentless buying pressure against that fixed supply. The first, and perhaps most impactful recently, are the exchange-traded funds, or ETFs. Specifically, the spot Bitcoin ETFs that launched in the US earlier this year. To give you some context, over 7,000 ETFs have launched in market history. But the Bitcoin ETFs, which just came online, they are the most successful ETF launch of all time.
Most successful.
Yes, and I don't mean by a little bit, I mean by a factor of 6. The second most successful ETF launch ever was the NASDAQ Q100Qs, QQQ. They pulled in about $6 billion in their first year. Bitcoin ETFs, in their initial period, pulled in an astounding $36 billion in their first year alone. And they've already brought in nearly $7 billion just so far this year. This is unprecedented institutional and retail capital flow, simply unprecedented.
$36 billion in year one versus $6 billion for the Qs. That's just an incredible difference. That's serious capital flowing in from investors who finally have an easy, regulated way to get exposure.
It truly is. And here's the crucial point illustrating the supply shock. Last year, these Bitcoin ETFs purchased a staggering 572,000 Bitcoin.
Right.
Now remember our fixed supply number. Only about 164,000 new Bitcoin are created each year through mining. So 572,000 Bitcoin is more than 100% of all the new supply that came onto the market.
More than 100%. So ETFs alone are buying more than is being mined.
That's exactly. Which means they have to buy from existing holders. And the history of ETFs tells us the assets under management tend to grow over time. The first year is usually the weakest as investors get comfortable. Look at gold ETFs since 2004. Good first year. About $3 billion. But they did significantly more in year 2, more in year 3, even more in year 4. We're here now at the very beginning of the Bitcoin ETF journey. Our prediction at Bitwise is we'll see about $50 billion in inflows this year alone into Bitcoin ETFs. The momentum is just beginning. It's a structural demand shift.
$50 billion predicted this year. That's monumental. And you mentioned there are other sources of demand beyond just the ETFs. What's the second major one? Maybe let's talk about.
The second major source is corporations. Beyond just MicroStrategy, which gets a lot of headlines for its huge Bitcoin holdings.
Right. Everyone knows MicroStrategy.
Yeah, but there are actually over 90 publicly traded companies that now hold Bitcoin on their balance sheets. These aren't just tiny startups. They're established firms across various industries. Tech, manufacturing, financial services allocating treasury to Bitcoin as a strategic asset, an inflation hedge, or a long-term store of value. This is a profound shift in corporate finance thinking.
90 publicly traded companies holding Bitcoin. That's a significant change from just a few years ago when it was seen as way too speculative for a corporate balance sheet. And how much are they accumulating?
Last year, these corporations collectively bought 320,000 Bitcoin. Again, let's put that in context. 320,000 Bitcoin is significantly more than the 164,000 new Bitcoin created annually.
So they're also buying more than 100% of the new supply.
That's right. Just like the ETFs, they are drawing from the existing pool of Bitcoin already out there. And the trend is accelerating this year. So far, just through today, publicly traded companies have already bought 180,000 Bitcoin. Once again, exceeding the new supply for the year to date. It truly underscores that it is fundamentally a supply and demand game, and demand is just overwhelming new supply from multiple powerful angles.
So we have ETFs, we have corporations. What's the third major source? The one you said is perhaps least talked about, but has immense implications.
The third source is governments. This is often overlooked in mainstream discussions, but it's a significant and growing development. It really validates Bitcoin's increasing legitimacy. There are now over a dozen governments that openly own Bitcoin, and this list includes, perhaps most notably, the United States.
The U.S. government owns Bitcoin.
Yes. In fact, the U.S. recently created its own strategic Bitcoin reserve just a few months ago, primarily from assets seized from criminal enterprises. While the motivations are complex asset forfeiture, maybe future strategic hedging, the reality is a growing number of sovereign entities now hold this asset. And here's a fascinating implication of this governmental and institutional adoption. Since the U.S. ETFs launched in January 2024, if you average out the total Bitcoin held by these institutional products and government reserves across the entire American population, every American, on average, now indirectly owns about $47 of Bitcoin.
Wait, say that again. Every American owns $47 of Bitcoin. Indirectly, of course, but still, that's a fascinating statistic. It speaks volumes about the level of adoption, even if most people don't realize it.
It really does. It tells you everything you need to know about what's happening. I've just made the case that there is this profound structural mismatch between burgeoning demand from these three powerful new sources, ETFs, corporations, and governments, and the fixed, limited supply of new Bitcoin. These new sources are collectively buying way more than 100% of the new supply. And what that means, fundamentally, is that existing people and entities who already own Bitcoin have to be willing to sell it to meet this incessant demand. And they are only willing to sell at certain prices. This dynamic sets the stage for the kind of sharp price action we've been seeing.
That structural mismatch demand consistently outstripping new supply makes a lot of sense for why the price keeps moving up overall. But we've also seen these distinct periods where the price seems to jump, then level off, then jump again. What's the human element or the market psychology behind that specific price action, those plateaus and then rapid ascents?
It's absolutely tied to human psychology and classic market dynamics, where supply and demand meet at specific price points. When the spot Bitcoin ETFs first launched in the US, we saw that immediate, significant price run-up, driven by pent-up institutional demand finally getting that easy on-ramp. The price surged from around $45,000 straight up to $72,000 pretty quickly. But then, almost predictably, it traded sideways for about 6 months.
Right, it stalled around $72K for a while. Why there specifically?
Because $72,000 was the previous all-time high from the 2021 bull run. And people, being people, often use these familiar, significant price points as psychological benchmarks. There were many existing Bitcoin holders, maybe those who bought near the previous peak, or just those wanting to cash in at that round number who saw their chance to break even or take profits after a long wait.
So basically, a lot of people who were underwater or just saw a nice round number decided to sell. That makes sense, a very human reaction.
Exactly. Remember, people have to sell for the new demand to be met because this demand from ETFs, corporations, governments is incessant. So the price hovered around $72,000 while that specific supply from sellers at the previous all-time high was absorbed. It was a test of conviction. But once that supply was exhausted, once those sellers at $72K were mostly out, what happened? The price broke decisively above $72,000, and as we saw, it ran straight to $100,000 with very little resistance in between. Shows the underlying demand pressure.
And now, as we speak, we've seen it pause again around $100,000, right? Is it the same psychology? Why that number?
For very similar reasons, yes. People are people, and $100,000 is a nice, round, psychologically significant number, a major milestone. Many retail investors especially were probably willing to sell at $100, seeing it as a substantial gain, a logical exit point perhaps. But it wasn't just retail this time. We also saw some significant one-time sales from a few large entities, specifically the GOX and FTX estates. They were liquidating assets to pay back creditors. These estates released about 100,000 Bitcoin onto the market, adding considerable supply right at that price point. The good news is, those specific estate sales seem to be largely completed now. That temporary pressure is mostly gone.
So the thesis here is that these plateaus, these sideways movements, are just the market efficiently absorbing available supply from sellers at these specific, often psychological price points. It's a natural function when strong demand meets willing sellers.
That's precisely the thesis, and I believe the data overwhelmingly supports it. My view is that as long as we have this relentless, incessant demand from ETFs, corporations, and governments who are collectively buying more than 100% of the new supply, forcing existing holders to sell, we will eventually exhaust the people who are willing to sell at $100,000. Once that supply is absorbed, once those sellers at this psychological round number are out, the critical question becomes, where does it stop? What's the next price point that triggers significant selling?
That's truly the million-dollar question, maybe the $200,000 question, given some predictions.
Indeed. Our prediction at Bitwise is that Bitcoin ends the year at $200,000. Now, that could certainly be wrong. Markets are always unpredictable, but $200,000 is the next nice, round, psychological number where you might expect a similar dynamic of selling pressure to emerge. But the core principle here remains paramount. Bitcoin's price, despite all the complexity and speculation, really is as simple as this: supply and demand. The supply is fixed, predictable, shrinking relative to new demand, and the demand is growing from unprecedented, powerful, diverse sources. This fundamental imbalance is the true driver.
You know, it's easy to look at Bitcoin today, all this institutional adoption, the price, and completely forget how truly nascent, unproven, and frankly risky it was just over a decade ago. It feels like it's been on this crazy journey from the fringes to the mainstream. Can you take us back, describe just how much of a Wild West it truly was, and maybe why people like us shouldn't feel bad about missing that very early boat?
Oh, it really was a completely different world, almost incomprehensible today. I vividly remember February 2011, I was running ETF.com, a leading resource for the ETF industry. Had a team of brilliant young analysts. We had a weekly brainstorming session, hottest topics. And in February 2011, Bitcoin crossed $1 for the first time, dollar parity day, they called it. One of my analysts, sharp young guy, led an hour-long, incredibly detailed session on what Bitcoin was.
Wow, you were right there at the beginning.
I was, and let me tell you, I walked out of that room and didn't buy any Bitcoin. Had to get on with my day. It seemed like an interesting curiosity, but the risks were just
Overwhelming.
And you're saying we absolutely shouldn't feel bad about missing it back then. Despite the headlines now, it's so easy to look back with 2020 hindsight. Absolutely not. You shouldn't feel bad, and neither do I. The reality was, in February 2011, there were enormous, very real, legitimate, frankly, existential risks. First, profound technical risks. Brand new, unproven technology. Would it even work long term? Could it scale? Was it truly secure? It was an experiment. Second, enormous trading risks. The largest exchange then was literally a PayPal address. You sent money, they sent Bitcoin within 48 hours.
A PayPal address? Seriously?
Seriously. I looked up the terms of service for that Operation New Liberty standard. It literally said, quote, "This may be legal as far as I know."
Oh my goodness.
That's the level of clarity we had, like buying gold from a guy in a trench coat. Third, severe custody risks. Largest custodian was Mt. Gox, which, as many know, famously collapsed a few years later, losing a huge amount of customer Bitcoin. Vanished, no FDIC, no SIPC, no recourse. And finally, huge regulatory risks. Governments, regulators mostly disliked it if they even understood it. There were very real reasons why sophisticated investors, even those paying attention, didn't feel bad about missing it then. The risks were palpable, legitimate, pervasive.
So that was then a genuinely risky Wild West frontier. What about Bitcoin today? How has it truly evolved from that precarious, unproven asset? How has it de-risked itself to the point where major institutions are now embracing it?
It has been substantially de-risked. The landscape today is almost unrecognizable compared to 2011. Let's look at those same risks. Custody. Bitcoin is now custodied by highly reputable, regulated firms like Fidelity, Charles Schwab, Coinbase Custody, financial giants, decades of experience, cold storage, multi-sig audits, far cry from Mt. Gox, institutional adoption, no longer fringe. The U.S. government holds Bitcoin. Over a dozen other governments. 9 of the top 10 largest hedge funds have exposure. BlackRock, with a $70 billion Bitcoin business through its ETF.
70 billion.
Yeah. Emory University, MIT, own Bitcoin. Ray Dalio, Stan Druckenmiller legends, traditionally conservative, now acknowledge or have exposure. Their due diligence is rigorous. Their adoption signals a profound shift. And accessibility and regulatory clarity. Night and day, no more sketchy PayPal addresses. You can buy Bitcoin in one of 10 high-quality regulated ETFs in the U.S., as easy as buying any stock in your brokerage account, your 401k, your IRA. The SEC approved these robust, transparent ETF structures after years of scrutiny. So no, you don't have to feel bad you missed it at $1. Everyone did. The risks were real. But a lot of that has been genuinely substantially de-risked.
That truly is remarkable. The journey from this may be legal as far as I know to the U.S. government holding it, buying it in your retirement account, speaks volumes. Now, when we hear cryptocurrency used broadly, it can be overwhelming. There are over 17,000 different ones out there.
Yeah.
How should we think about this vast universe? Are they all trying to do the same thing as Bitcoin?
That's a fantastic question because 17,000 plus sounds ridiculous, and frankly, in many ways it is. Many are copies, experiments, likely failures. But the key is not to think of them all as cryptocurrencies like Bitcoin trying to be money. Instead, think of them more broadly as crypto assets, or maybe even better, as distinct software companies or software protocols. They're designed for different purposes with different underlying tech.
Software companies.
Yeah.
That's an interesting reframing. How does that clarify things?
Well, every crypto asset is fundamentally two things. The asset itself, the coin, like Bitcoin, and the blockchain it runs on, which is essentially open source software, a distributed ledger. And just like Microsoft Word, Salesforce, and Zoom are all software, but designed for very different tasks, solving different problems for different users.
Right, totally different functions.
Exactly. So too are different crypto assets, built with different purposes, excelling at wildly different functionalities. They're not all aiming to be digital cash or digital gold.
Okay, that analogy helps a lot. So what is Bitcoin's specialized role in this software landscape? What is it designed to be exceptionally good at? And what are its trade-offs because of that focus?
Bitcoin, as software, is designed to be exceptionally good at one primary thing, being a robust, censorship-resistant, verifiable, secure store of wealth. Digital gold. This means it's very conservative software. It almost never upgrades. When it does, it's minor because every upgrade introduces risk, and its primary goal is absolute stability, immutability, security for wealth preservation. Minimal change, maximal security. It's also incredibly decentralized software. Hundreds of thousands of operators worldwide. Makes it exceptionally robust, resistant to single points of failure or control. It changes very, very slowly through distributed consensus. Functionality is intentionally limited. Send, receive, hold, or destroy Bitcoin. That's basically it. Like a calculator does its specific vital job incredibly well, but it's not a multi-tool for complex applications. Its value comes from that singular, uncompromising focus.
So Bitcoin, digital gold, slow, steady, focused on wealth storage, basic transactions. What about Ethereum, the second biggest one? How does it differ fundamentally? What problem is it trying to solve?
Ethereum came after Bitcoin, created with a much broader vision. Its creators looked at Bitcoin and said, okay, storing wealth without a bank, moving money fast, that's amazing. But what if we could program your money? What if you could program money to act like the New York Stock Exchange, executing complex trades automatically? Or act like a bank's lending agent, automating interest and collateral? Or act like the Visa network for decentralized applications? It aims to be a foundational layer for a new kind of internet, Web3, where applications are decentralized, running on the blockchain.
So a much more expansive, programmable platform, like a global computer for decentralized apps.
Exactly. Ethereum's programming language is way more complex than Bitcoin's. It updates much more frequently, often 2 major upgrades a year. This allows for vast arrays of applications. DeFi, NFTs, gaming. It's never going to be as good as Bitcoin at being digital gold, precisely because its complexity and updates introduce more potential risk, which isn't ideal for a pure store of value. But it's infinitely better than Bitcoin at providing that foundational layer for a new internet, a new financial system built on smart contracts. We're already seeing firms like BlackRock issuing tokenized money market funds on Ethereum, not Bitcoin. Stocks, real estate, dollar payments are increasingly moving onto Ethereum to leverage its programmability. They do fundamentally different things.
That clarifies the landscape immensely. It's not a zero-sum game then, more like different digital assets serving distinct complementary purposes.
That's precisely right. I suspect in the future, Bitcoin will solidify its role as the ultimate digital, gold-reliable, immutable, censorship-resistant wealth storage, a global monetary base. And Ethereum will serve as a foundational layer, the operating system or infrastructure for a new decentralized internet and financial system. Different tools for different jobs, both incredibly important.
Well, we've covered a tremendous amount of ground in this deep dive into Bitcoin. We've unraveled that core mystery of its value, understanding it stems from the truly critical, unique services it provides in the digital world, rather than traditional cash flow. We've explored its surprising strength as a store of value, even comparing it favorably to gold. And crucially, we've unpacked those powerful, undeniable supply and demand dynamics, the constant pressure from ETFs, corporations, governments driving its price. Perhaps most importantly, we've seen how Bitcoin has substantially de-risked itself, transforming from that niche, high-risk novelty to a legitimate, institutionally adopted asset.
And that last point is vital for you listening to consider. The skeptics who continue to dismiss Bitcoin, clinging to outdated objections about early risks or lack of cash flow, are genuinely on the verge of missing one of the most significant financial transformations of this generation. Given that governments, major corporations like BlackRock, top universities, now hold Bitcoin and it's easily accessible through regulated products, what does that imply about its long-term integration into the global financial system? And what does it mean for you to be prepared for the profound financial shifts that are still unfolding? That's the question to ponder.
And on that thought-provoking note, that's all the time we have for this deep dive. If you found this discussion insightful, please do follow, like, and share the deep dive wherever you get your audio. And for even more cutting-edge insights and analysis on Bitcoin and the broader crypto landscape, be sure to follow What Bitcoin Taught Me on Twitter, X, Nostr, Bluesky, Threads, Instagram, Facebook, and LinkedIn. We'll see you next time.